Are you looking to learn more about investing in the central Indiana real estate market? You've come to the right place. Welcome to the Indy Real Estate Investing Podcast with T&H Realty, where we discuss all things related to investing in the central Indiana real estate market. Thank you for listening and enjoy the show.
Hello, everyone, and welcome to another episode of the Indy Real Estate Investing Podcast. I'm your host, Jeremy Tallman with T&H Realty. We are a residential property management company that services the central Indiana market. Today's guest is Josh Heintz. Josh serves as the Vice President for Corporate Development at Lending One. Welcome to the show, Josh.
Hey, Jeremy. Thanks so much for having me.
Yeah, it's good to have you on. I've known you kind of passively a little bit over the last couple of years. We reconnected recently in your role there at Lending One and wanted to bring you on here. So just give everyone, Josh, kind of a quick 30, 60, 90-second overview of who you are, what you do, and kind of what led you to where you are today.
Yeah, so Josh Heintz with Lending One. Have been with Lending One for about 2 years now. And before I came to Lending One, I spent a couple of years in the property management space with a pretty large national real estate company called Evernest. They're headquartered out of Birmingham. I'm personally based in Birmingham, Alabama. And before I went to Evernest, this would have been in 2021. The prior 10 years I spent outside the industry. So I wasn't in the real estate space at all. I worked for a nonprofit that owned a number of for-profit subsidiaries, and I ran those for-profit companies for about 10 years and enjoyed that, but was looking for something a little bit different and got networked in with who wound up being a pretty significant juggernaut in the real estate property management investment space, and a guy named Matthew Whitaker down in Birmingham, Alabama. And we spent some time together, and I came over to run the M&A shop for them at Evernest. And so spent a couple of years in corporate development with those guys, buying property management companies as part of their roll-up strategy. And so we did that together for a couple of years, had a chance to look under the hood of a lot of property management companies and talk to a lot of investors and really got introduced to the space. And when it was time for me to transition out of that role, was introduced to some of the fine folks at Lending One, and they were looking for somebody to come in and connect with people that were not directly inside the investment space, but that were more adjacent to investors. And so one of the things that we've done is we've developed a program where we work with property managers and other people's prop tech companies and wholesalers and real estate agents and agencies and people that are touching investors but may not be investors themselves. And so that's what I do for Lending One, is I go out and try to develop corporate relationships with larger companies, share a little bit about what it is that we do at Lending One. There's a lot of misunderstanding around our space and the type of products that we offer, and try to find the best types of partners that we can to help their investors or their clients grow their portfolio, grow their wealth through real estate transactions.
Yeah, you kind of reminded me. You talk about when you were with Evernest. We were at some breakout session at NARPM, I don't know, 3 or 4 years ago, whenever it was, and it was on like mergers and acquisitions. And I remember getting a tap on my shoulder, and your card came over, and you're like, "Hey, call me if you ever need, if you want to talk about it." And I was like, "Oh, Evernest." I kind of knew Evernest back then, or the name at least. And maybe I'd known Matthew at that point. But so yeah, I've kind of followed your name, and then your career as you went on, and caught up at NARPM a couple of times, I think, as we've met up. So, Josh, you and I did a Zoom call several weeks ago, maybe a few months ago at this point, and you were discussing kind of all the products that you guys offer there at Lending One. And I'll be honest with you, I'm an investor. Like, I've been an investor for a long time. I've not been a mortgage procurer in a long time, right? And so I left that call just kind of with my head spinning, like, wow, there's so much available here to people. Because back when Scott and I started investing, the product line for mortgages was like really thin. Like it was like basically, how many years do you want and how much you putting down, right? That's what it was. That's kind of what we could choose from. And our plan was highest amount of years, highest amount of amortization, lowest amount of down payment, because we really use leverage to build our portfolio. We've, reorganized a bunch of that over the years, shorter AM terms and things like that. But today there's just, as I mentioned, it's like a smorgasbord, literally, of different products for investors out there to choose. And I can only assume, I don't know if you have insight in this specifically, but I can only assume it's because there's a bigger demand for lending from investors, right? I think most mortgage companies did primarily until 2008, call it 2010, mostly for products were for owner occupied stuff. But when we saw investors start crushing the market in the teens, we'll call it 2000 teens, maybe that's when the product lines really opened up for investors, because it seems like there's just a ton of them now.
Yeah, no, you're absolutely right. So there was, this real gap in the market after the great financial crisis because investors still needed capital. Banks obviously had, tightened the reins quite a bit. And this private lending space at that point didn't really exist. You had, there's a big misunderstanding between what is kind of traditional hard money and what is like private lending. A lot of people conflate the two things, and there are a lot of similarities. The primary difference between the two is hard money tends to be hyper localized. So they're small family offices or high net worth individuals that may have 5, 10, 15, $20 million that they can lend out on a short term basis, but they're usually very comfortable doing that because they know the market so well. And so hard money tends to be very, very local, and it's all short-term products. They'll loan money for a flip, and they would leave the other type of facilities, be a 5-year, 7-year, 10-year, with a balloon for the banks. And so it left this vacuum in the industry where there was really a need for like a 30-year mortgage product, but on investment properties. And so that's where these DSCR loans, these debt service coverage ratio loans, were really born. And so Lending One, so our current CEO and co-founder, Matt Neisser, with the other co-founder of Lending One, started the company back in 2014. And around this time is when you saw a few of these private lenders coming to the market. And so their thesis was, if we could go out and create a 30-year fixed rate mortgage product, there are probably some companies that, just like, owner occupied mortgages, would buy these in the secondary market. And so they started testing that thesis in and around the Southeast. And so there was a significant amount of demand that came around. And so that demand has just grown ever since, because investors, once they learn about this space, that there is kind of a friendly way to go about getting a 30-year fixed rate mortgage for oftentimes what may be at or a little bit less than what you would see through a bank, but just without the bureaucratic red tape. That's where this type of product really was born and takes off.
Yeah. So Lending One has positioned itself, I think I remember you telling me, you all only lend to corporations. Is that correct?
Yeah, so in a roundabout way. So we only lend to entities, not just corporations. So yeah,
Gotcha.
but generally speaking, an LLC, S corp, C corp, a trust, so long as that trust is a revocable trust, but we only lend to entities. Now, we do need a personal guarantor on those loans, but the loans themselves close in the name of an entity and only in the name of an entity. So we could not close a loan in an individual's name. That loan has to be closed in an entity.
Yeah. It's interesting because you brought up that real estate needed 30-year mortgages, companies. And I remember now, you kind of made me think back. When we got those 30-year AM loans, say back in 2000, 2005, when we did a lot of like loan procurement, we were out getting a lot of loans for long-term buys. We always had to buy in our personal names. Right? You could not get a 30-year loan under T&H Properties, which was what it was and still is today for all our property deals. That's interesting. So, Josh, I want to talk about something right out of the gate before we get into some of your products, which I think is very interesting. But there's a lot of messaging out there and from national folks about how the single family investor is dead, like are dying, or has been hurt badly by interest rates, and demand is way down. investor appetite's way down because the margins aren't there. But in your 2 years there, maybe you have a wider lens you could look at it, but have you seen, like, you're a national player, right? So you see all
Right.
parts of the country,
Yep.
but are you seeing investor demand wane? I mean, do you guys have any data on that, like loan originations or whatever you use to
Yeah.
measure that?
Right. So we certainly track our business in terms of, origination, volume, and, total unit count and that sort of thing. And I can tell you the industry is certainly not slowing down, right? I mean, a
Interesting.
lot of people now, the institutional shops certainly have slowed down.
Sure.
So where you had a lot of these larger mid-market players that were coming in, they were scooping up, properties by the dozens, if not the hundreds.
Right.
That has mostly stopped, and that really came to a screeching halt back in 2023 when the Fed began raising their rates.
Yeah.
But the small investor, what we're starting to see now is with the softening of a lot of prices across the country, rent growth has certainly waned, flattened in some places throughout the U.S., but it's also still burning red hot in some markets too.
Yeah.
So some in the Northeast where there was, chronic underbuilding for a number of years, and a lot of those new builds haven't come online. You're still seeing a lot of activity and a scarcity of inventory in those markets. And then you've got markets in places like, South and West Florida where you're seeing a lot more inventory bubble up to the surface. But even in those markets, now you're getting a lot of investors that, as you've got some prices that are recorrecting in markets like that, or in Austin, Texas, or in Boise, Idaho, where prices are reversing to some extent, people are still finding deals. And so
Hmm.
what you wind up seeing are a lot of people that are looking for value add properties that are getting really, really good deals with new builders. So a lot of builders who historically have not been very interested in working with investors, now that new builders are having a little bit of a difficult time in certain markets moving inventory, they're a little bit more motivated to come in and help with closings and to even subsidize, rates in a lot of ways, especially for the bigger builders. So certainly still a ton of activity that's happening across the U.S. And I couldn't really point to any area in the country where it's slowed down or stopped. It's just the mix has shifted a little bit.
Yeah, I want to get into that a little bit because you guys offer products for people who flip homes, people
Hmm.
who buy and hold traditionally, new construction. Before we get into like the specifics of what you offer there,
Yeah.
you kind of alluded to it, so I want to keep going with it. Has your mix changed over time? I'm hearing just locally, and I know you may not have like a perfect beat on the Indianapolis market, but that people are getting more interested generally in flipping than they are buying and holding. Are you
Yeah.
seeing that from are you getting more originations on people who are looking to flip?
Oh, 100%. Yeah, there's no question about it. So where, and it makes sense logically, right? I
Hmm.
mean, 2020, 2021, I mean, interest rates at the floor. We saw a lot of people that were going in and refinancing a lot of their properties. So there's not as much refinance activity that's
Sure.
happening. And a
Yeah.
lot of people are struggling to get some properties to pencil with long-term rates. So for those people that are struggling a little bit more, but they want to stay active, because reality is, look, we know real estate investors, they need to invest, right? It's their
Yeah. They want to
job. It
invest. Yeah.
doesn't, yeah, it
Hmm.
doesn't matter what's really happening in the macro climate. They've got to still figure out a way to get deals done. And so you're seeing a lot more activity picking up with like wholesalers that are trying to turn these properties over to investors. And so certainly a lot of the mix, I would say, a couple of years ago, it maybe have been, 80-20 or 90-10, 30-year fixed, new purchases or refis versus
Right.
flip. And now you're probably talking closer to 50-50,
Wow.
where you've got a lot of investors now are reaching out, finding those. And so this is all a theory, and this is just my personal theory. I can't
Yeah.
speak for anybody else, but that what we do know is there is an unbelievable amount of deferred maintenance across the country.
Yeah.
And so now that you're seeing a lot of properties that are kind of sitting in terms of the asset price themselves, you probably got 80 to 90% of the country is at the highest place that they've ever seen. Inventory's rising. People are starting to get nervous, and they're sitting on properties that have cash flowed very well for them at low rates for a long time. They want to take advantage of, high markets. There's a lot of people that are aging out in retirement that are wanting to
Yeah.
turn these assets. And so that, for the investor that's held a property for 10, 20 years, they've seen that property cash flow. Now they're ready to get out of the game. When they're turning that property, they're having to make concessions on the price of that property because of the enormous amount of deferred maintenance that's been in place now for a number of years. And so people are still finding those opportunities. And so obviously they've got to put money back into that property, but we're seeing a little bit of a revitalization of people that are executing with the BRRRR strategy because they're finding value add properties, and that's how they're getting them to pencil long term as rentals.
Josh, it's interesting because we bought a lot of the rentals that we still own today exactly that way. I mean,
Yeah.
we didn't, the term BRRRR I've talked about before didn't exist back then. That wasn't a thing we talked about. But
Right.
but there were a lot of investors that were like at the end of their ropes, like maybe from a age standpoint or just like, I'm done with this. And we went and bought at significant discounts. And I remember thinking and talking about Scott and me, like, we don't want to ever do that. Like we want to be, when we sell our properties, we want to make sure that they look really good and they,
Yeah.
perform well and things are like, we're not going to put new kitchens in all our properties. We understand that doesn't make any sense, but, maintained well. We do the preventative maintenance, and then, during turns, we take opportunities to upgrade where needed. And that's hard to do. Like, frankly,
Yeah.
it can be a very big grind. So let's talk about flippers. If I come to you and I say, hey, I got a really good opportunity on this property, what kind of loans am I able to get, products am I able to get from Lending One if I flip homes?
Yeah, so the biggest thing with us is, one, we are specifically in the single family space, and so that can mean different things for different people across the country. For us, that's anything that's parceled with 1 to 4 units. So
1 to 4. Okay.
yeah, so it's anything single family detached all the way up to a quadplex. We kind of position in that space of the single family. But if somebody's looking for any of those to flip, then they can certainly come to us. We'll loan up to 90% on the purchase price of the property. So you may have to put as much as 10% down, and then we'll loan up to 95% loan to cost on that property. So we'll loan up to 90% of the purchase. We'll give you 100% of the rehab funds that you need to go in and renovate that property, so long as the entire loan doesn't exceed 95% loan to cost. And also, so long as it doesn't exceed 75% of the after repair value or after renovation value as we see it in the budget.
Okay. So how does that work? Do you do a draw system of some sort and confirm
We do.
repairs?
Yep.
Or is it,
Yeah, absolutely.
I'm just curious, how's that work?
Yeah, so if somebody comes in, they'll come in, they'll put, whatever down payment they're going to put down on the property. And then once the property is purchased, we actually take whatever they submit as a budget that's approved for what they plan on doing with the renovation. So let's say that you're coming in, you're going to buy a $200,000 property, you're going to put $100,000 into it. On that $200,000 purchase, we would loan up to 90%, so $180,000. We would loan the entire $100,000 to renovate it. But what we're going to do is we're going to set that $100,000 in an escrow account.
Gotcha.
And so you're not going to pay any interest. These are interest-only loans, obviously, as short-term loans, no prepayment penalty on any of those. And you can draw down, money whenever you need it. Whenever something's been completed, you'll go in, take a picture. We'll see that, the whatever is needed to happen on that property. So you said you were going to put in $10,000 for floors. The $10,000 for floors was put in. Depending on kind of where you are in the country right now, it may be that we need to send an inspector out there to make sure that the floors are in place. It may be that we're rolling out some new systems now where you can simply just take pictures that are geotagged. And so if we can see that those floors are in place, then we'll release those funds. And so the good thing about that is you're not paying, because these are short-term interest-only loans, you're not paying any interest on any undrawn funds. So that $100,000 is sitting there interest-free until you begin drawing it down as needed. And so some people that have a lot of capital that want to just use that as a safety net may not ever wind up paying any interest on that because they let it just sit there. And then for others who need it, then, we try to make it a very easy process to be able to draw those funds down and get out what you need after you've done the work.
How many closings will you have in a flip loan like that? 2?
No, there's a single closing. Yeah.
Is a single closing. So I go to you
hmm
and I get initial closing, the funds for the purchase, and then when it's all said and done, whatever I've drawn out, you just want to make sure the ratios match up to 75% is what you said?
Yeah.
Okay.
Yeah.
So I may have
Of
to
the
come in
after
with
repair value.
okay. So I may have to come in with more money if my repair value, if I
Yeah.
miss a little bit.
Right, 100%. So that's where, as a part of the process, you're going to submit a budget, is what you see that it's going
Yeah.
to take in renovations. And so we're going to evaluate the property as is. We're going to review the budget, and then we're going to run our analysis to see what we think that property is going to appraise for after the renovations are done. And so
Gotcha.
long as you stick at or under 75% of your initial purchase and rehab versus the after repair value, then all is gravy. But yeah, certainly if you're going to be a little bit over, you may have to put some more money in the deal up front.
Yeah. So you need to be smart. I mean, obviously, when you flip a home, you're trying to add value. And it shouldn't be a
100%.
$1 for $1 increase, right? So,
No.
so you want to add value, and so that makes
Yeah,
sense why it's 90% to start, but then 75% on the back end. So that's great. Interesting product. When you're
yeah.
doing a
And
lot
we're
of it, it
seeing,
sounds like.
oh yeah, we're seeing a ton of activity with that because I mean, people, that those are the opportunities that they're seeing now. And so it
Right.
gives them a little bit, it gives the investor a little bit more flexibility to figure out, how much money they can, how cheap can they get that property, and then how can they turn it, and then we've got an interesting product that will kind of bridge that into a 30-year fixed rate loan. But yeah, a lot of people nationwide taking advantage of that product, and it a very similar product to that. We do new construction as well. So people that are
Hmm.
doing ground up, people that are buying infill lots in existing neighborhoods that are doing, ground up new construction. We have a product that's different but very similar to that fix and flip product. Again, it's just kind of a short term. You submit a budget. I mean, there's different, a little bit of different rules and regulations around how we distribute those funds and some of the guardrails around it, but a very similar short term product
For new construction.
for new construction, right?
Yeah. Do you typically work on the new construction side with builders, or are you is your client typically the builder on new construction stuff?
So they're typically, usually what we wind up seeing is it's an investor that has a contractor that they've
Yeah.
worked with. It's, built
Yeah.
a number of different houses. And
Yeah.
so we do require that. So somebody who has zero experience, they've never built a house themselves, they can't
Yeah.
come in. Because we are experience based. So for somebody to come in and do a flip, we're not a good source for somebody who has never done a flip before. So
Gotcha.
you need to have, one or two of those under your belt before you come to us and have those conversations. That's where you typically see hard money come in. And, we talk a lot about the differences between true hard money that's localized, larger national lenders like ourselves, and then banks and credit unions or depository institutions that are more conventional lenders. And the differences between those three are pretty vast, but you need all three. I mean, if
Yeah.
you're an investor and you're trying to, I mean, it depends on where you are on your investment journey, but if you're an investor, you need all the resources that you can get. So if that's, hard money may be a great option for some
Yeah.
deals. And
Absolutely.
then, a private lender like us for others, and then conventional lenders, you need to have a great relationship with your bank and with your credit union because sometimes that's going to be the best thing for you as an investor. But it's just being aware of what the options are and knowing when to deploy which resource on which product is where, the real magic comes in.
Yeah. That's good stuff. So the interest rate between a flipping loan and then a new construction loan, are they since they're similar products, they have similar rates, or do they have different rates depending on different things there?
No, they're usually around the same. So all of our rates are determined ultimately between kind of a matrix of two different things. One, it's the personal guarantor's FICO score. So again,
Okay.
we close in the name of an entity, but every closing has to have a personal guarantor. So
Yeah.
it's the personal guarantor of the entity, their FICO score, and then the leverage needed. So the more money that you need, the lower your credit score, the higher the rate's going to be. The less money you need to borrow, the higher your credit score, the less the rate's going to be. So
Okay.
it's really just a blend of those two things. And then by product, so you've got, things like that are short term, like our bridge or fix and flip loan. We kind of use those terms interchangeably with new construction. Generally, they're around the same rate.
Gotcha. So it's August 12th. I want to make
Hmm.
sure I say that so I don't put you in any corner. But like, what,
Yeah.
what kind of rate would I expect on those products?
So you'd be looking at, I mean, for the average person, you're going to be
Yeah,
somewhere between 9 and 10%. So
9
these
and
are,
10%.
interest only, somewhere between 9 and 10% is going to be kind of the top line rate. And then the fees associated with that are typically going to be anywhere between 1 and 2 points on the front end, and that's going to be determined just based off of your experience. So the more
Gotcha.
flips that you have under your belt, the lower the origination fee on the front end, the more novice that you are in that, it may get a little bit higher.
Okay. That's great. So let's go over to the buy and hold, kind of my
Yeah.
loan of preference here.
Yeah.
When talk about, you mentioned DSCR. What all products you have out there for someone that says, I'm buying and it's mostly turnkey. We know that can be a a crazy term and left a lot of different interpretations of what turnkey means. But I buy one and there's not enough work here to need any sort of flip loan. I'm going to keep it anyway. But what do you have there? And maybe I should step back because I do think you offer products for people that want to buy, fix up, and hold, the BRRRR strategy. So talk about those different products there.
Yeah, so we talked a little bit about bridge. So somebody who's coming in to be able to just flip that property. If they want to flip it to sell it, great. If they want to flip it to hold it, that's perfectly fine. If they tell us on the front end that they're planning on burning that property, they're going to flip it to hold it and rent it out, we'll put them into what we call our fixed to rent product. So ultimately, it's two separate loans because there's the value add buy and renovate loan of the fix and flip, and then a 30-year fixed rate DSCR loan. We just blend them into one so that you're not paying two full origination fees, then all of the things that are associated with that. So it's kind of like a buy one get one half off. It's kind of the way that I like to describe it. So you wind up getting a lot of value back. We'll discount the interest rate on the interest only period if you tell us on the front end that you're going to turn it into a 30-year fixed rate rental. And so we try to get, like, we'll comp the appraisal when it comes to doing it. And so we try to be a good partner in that sense. But a lot of people who are just looking for the 30-year fixed rate DSCR loans, the biggest thing with that is kind of that DSCR. And so for those people who may be listening who aren't familiar with DSCR, it stands for debt service coverage ratio. And so the way it differs from your average conventional loan that you're going to get with a lender on like an owner occupied property, which is a DTI loan, they're looking at your debt to income ratio. So really what a bank or a credit union is going to care about is your personal ability to pay
Right.
back that loan.
Yeah.
That's why they care about seeing your W-2, and they want to see, your tax return and that sort of thing. We don't ask for your W-2. We don't care about your tax return because that's not really important to us. What matters to us is the coverage ratio part of that. So can the property pay for itself through the income that it's going to receive? So if you've
Right.
got a rental that's going to be able to rent out for $2,000 a month, does the principal, interest, taxes, insurance, and homeowners association come in at less than $2,000? Or at or less than. And so that's how we evaluate our ability to finance that property, is not how much you, Jeremy, make in your W-2 income job. It's, does 123 Main Street that you're buying that rents for $2,000, is the mortgage less than $2,000? And so if the
Yeah.
property can simply cover its own obligations, that's what we lend based off of. Now that coverage ratio is going to be determined by the FICO score of the personal guarantor. So let's say
Hmm.
you, Jeremy, come to us and say, hey, I've got a property that's going to rent for $2,000. The principal, interest, taxes, and insurance is, $1,950. So it's like right there, you're barely covering it. The question is going to be, okay, Jeremy, what's your personal FICO score? If your FICO score is greater than 720, then we only require a one times coverage ratio, which
Wow.
technically means You can rent it for $2,000 as long as the principal, interest, taxes, insurance, and homeowner association doesn't exceed $2,000, then we'll rent it to you. If your FICO score is less than 720, we require a 1.2 times coverage ratio.
Yeah.
So I can't do that math off the top of my head, but whatever, so that may be a $1,700 mortgage or whatever that number is to make sure that $2,000 rent can cover it. And so that's what we base the actual coverage ratio off of. And a lot of people really like the idea that they can put a 30-year fixed rate mortgage in their entity's name, because as long as you don't default on that payment, it's never going to be reported to your personal credit. So you can free up your personal credit to go and do other things. If you want to buy a boat or buy another secondary vacation home or whatever that may be, you can put that in your name and you can free up all the other debt. Because when you go to the bank, they care more about, your personal ability to repay that loan, where that's not really our principal concern.
Yeah, and maybe this is too black and white, but it's kind of like that DTI loan mostly focuses on lending to the person, where, making sure the person's worthy. You're making sure in the DSCR that it's the property's worthy of lending on it, right? So you're looking at it, and maybe it's probably not putting in that neat of boxes, but I can see how people could look at it that way. So Josh, interest rates on the DSCR, fixed to flip, those type of things, similar rates or what am I looking at there?
No, fortunately not. So right now and again, all of the rates are based off of personal FICO's credit and leverage. So right now, if you came to us and you wanted to put 20% down on a new purchase of a home, you're going to be looking at a rate somewhere in the neighborhood of 6.75 to 6.8 is where that 30-year fixed rate number is sitting today. Again, and I like the idea that we're qualifying this based on time, because obviously these things move every day, but they're moving in the right direction. So I know a lot of people over the summer months and recent, we've been in this window where rates have been real sticky in that 6.5 to 7.5% range. But for us right now, if you were looking at a new purchase, then you would be right around 6.75, 6.8. And that's 30-year fixed. I mean, just like you would see with a conventional lender.
Yeah, that's a good rate. My son, I've talked about him on and off on the podcast. He lives in Tennessee. He just got married and got a house under contract to buy for him and his wife. And it's 6 3/8 was their interest rate. So that was pretty, for owner occupied. I thought that's a pretty solid rate. I told him, interestingly enough, that's 1 point less than his mom and I got on the first house we bought to live in. We were 7 3/8. So, and he's complaining that insurance, he's like, they're just so high. I'm like, you have no idea. They've been better, but in the whole scheme of things, they're not all that bad. So speaking of interest rates, Josh, you mentioned that we have seen, a little softening and things are, looking a little better on that front. What's your, and maybe does your company have a position on this? I mean, I'm sure you got very smart people there that kind of look at the data and economics of, the macroeconomics of things and what influences interest rates. But what's your prediction? I want to put you on the spot, but maybe near term and then 1 to 3 years. What do you think interest rates may do here?
Yeah. Hey, look, I have no problem putting a bold bet on something I know not that much about, but no. So we have, a lot of great people here that are, keeping, close eye on the markets and, what's happening. The one thing that we know for sure is that forecasts are wrong. We just don't know to what extent that they're wrong. And so, a lot of people have been predicting that rates are going to stay roughly the same through the end of the year. There's a lot of mixed signals, obviously, that have come from the Fed on whether or not there may be a cut that's coming. All markets have already priced in all of those presumptions, though. I think that's probably one of the things that a lot of people are, really confused by is, if you get to, like, right now, the signal for, rate cuts are what they are. And so, if we wind up getting to a September meeting where they cut rates, people are going to expect interest rates to shift, but that's not how the market works. The market's already baked in those presumptions. And so in the event that it happens, now when they go against what, these analysts are expecting, that's when you see major movement in the market. But we really think that things are going to continue to improve moderately so on the interest rate front, but we're not really expecting any massive pullback in rates. So,
Right.
the people that have been, it was funny. I can remember being at some of these conferences in late 2024, and everybody was saying, let's just survive through 25, right?
Yeah.
And it's
Yeah.
like, okay, and that's great. But the people that are expecting, 2026 to bring 4% rates, it's unlikely to happen. We can never say what is definitively going to happen. But, I think that a lot of people that are hoping for rock bottom rates, we saw a once in a lifetime
That's right.
window, right?
That's
And
right.
so for the people that are waiting on 4%, if we get it, you're not probably going to like what we had to walk through as an economy and as a country to
Great
get
point.
there. So
Great
let's
point.
not hope too much
Yeah.
that winds up happening. But we're expecting things to get, maybe moderately better over the course of the next couple of months. What we're really expecting is that these investors that have begun to find a lot of deals where they've gotten properties that had a ton of deferred maintenance and they've got value add pieces to them. Look, I mean, we're not seeing any real data that shows that delinquencies are going to result in any type of explosion like they did
Hmm.
during the financial crisis of a
Right.
lot of foreclosures. But there are certainly still deals that are out there. There are a lot of retiring investors that are
Yeah.
looking to move off of pieces of their portfolio. So if you're an investor that is interested in continuing your activity, this is really just the time to, put, 10 toes down into networking. I mean, that's
Hmm.
really where you need to be. I saw a video that you recently posted where there was a big investor meetup that was happening. And, those are the types of things that are critically important
Yeah.
because being tied into where the deals are, that's how most of these things are going to move anyway. They're not going to move from the MLS, especially if it's already an investment property as is. A lot of it's going to move through word of mouth. And so being tied into your local REIA, being networked in with your wholesaler, having a conversation with your property manager, so that I mean, you've got, many, many, many properties that you guys manage. You have great relationships with a lot of your investors. So you're going to know when somebody's maybe a year or two away from that horizon where they're looking to get out of that space. And so, keeping your ear to the ground as an investor is critically important in this market because interest rates will likely moderately improve through the rest of the year. But we're talking at, if you're in the 6.5 to 7% range right now, maybe it's going to come down 25, 35 basis points. It's not going to
Right.
be this massive shift that's going to happen. And then maybe in a best case scenario, hopefully we're sitting here a year, maybe a year and a half from now, talking about rates being in the fives. But people that have any hope of it going into the fours, there are some really, really, really bad things that would have to happen for that to be true.
Yeah. I think that's a great way to think about it. And I don't think people do. I think, like, well,
Yeah.
I got a primary residence at 3% one time. It's going to happen again. And it's probably not.
Yeah.
Well, that's great. Well, Josh, I've definitely learned some things. Appreciate you coming on. I'm happy to see the lending activity from the investor standpoint is still very strong nationally. I think that's awesome. I love keeping 10 toes down on your networking. I think it's a really neat
Yeah.
way to look at it. Relationships are so important, and maybe they're even more important today to tap into that investor base that's like, I'm not really sure I want to put this on the market. I got a lot of properties, and maybe you can make a deal happen. It's
Yeah.
cut the realtors out if you need
Oh
to.
yeah.
So
Well, and people shifting strategies is interesting too. We've heard of a lot of people that have moved from their short-term rental position with their Airbnbs, which Airbnbs were super, super hot,
yeah,
during COVID, and people could work from anywhere, and people converting those now, from
yeah, that's
short-term to
absolutely, yeah,
long-term. And
yeah,
so, and the good thing for us is we do a little bit of all of it. So we'll finance a short-term. If you got a Airbnb, we're happy to finance that. We're happy to do long-term. One of the things that's probably less understood is in the portfolio space.
mm,
So a lot of lenders don't do this. One of the things that makes Lending One pretty unique is our portfolio product. So if you've
yeah,
got between 3 and 20 properties that either you have aggregated over a period of time, or if you want to do them in a new acquisition, we've got a portfolio loan where you can put 5, 10, 15, 20 properties
mm,
all in one loan. It's one underwriting process, one origination fee, one loan, one payment. Simplifies everything, and you get a little bit of a haircut to the interest rate if you group them all together. And so that's a product that, as a lot of investors have been shedding their portfolio of deferred
Yeah.
maintenance homes, people are seeing, an investor that might have a tranche of 6 or 7 or 8 properties and they want to buy them all at once. We can do that both on the new acquisition side as well as on the cash out refi side for people that may have been holding some properties for a long period of time.
Yeah, I think that we did the same thing. I don't know if we called it that back then. We called them blanket loans, maybe, but
Yeah.
we had, like 5 loans with this lender and 6 loans with that lender, and we had a bank come in and say, "Hey, we'll just put these all together, like you mentioned, one loan, one payment," and it's awesome. I mean, it really is. It creates a lot of efficiencies within the
Yeah.
system to do that. So it's a great product. Highly recommend if people have, slowly built that portfolio up over time and need to just like, hey, I'm tired of paying 6 different people or 8 different people. Or if they, like you mentioned, make an acquisition with a bunch of properties, they can just go to bat one time with the loan and be done with it. So
Yeah. Or if they
those are
found
great.
a new value add property that they wanted to pick up, or if they needed to pull some cash out, being able to take, a lot of investors that have aggregated those properties over a long period of time, over the last 15 years. I bought one every 2 or 3 years over the last 15 years. And so I've
Yeah.
got varying degrees of equity built in them. I've got
Yeah.
varying interest rates on all of them. So let me
That's
just
right.
pull them all together, kind of one thing, do a cash out, because I may have found 2 or 3 more properties. I want to go and buy a couple more. So this is a way
Yeah.
to just, pull a little bit of cash out of everything. So we've seen a lot of that, a lot of people using that product this year to pull cash out to go faster as they're seeing
That's
more
great.
opportunities come up.
I think that's smart. I do. I mean, as long as you're smart about it and don't get too,
Oh, for
over
sure.
leveraged, I think it's great
Yeah.
to use other people's money to build your wealth. And I think it's really smart. So, well, Josh, how do people get a hold of you? If they're interested in some of all this, again, smorgasbord of products, how do they get a hold of you?
Yeah. So yes, we're happy to talk to anybody, any way that we can help out. Would love to chat with anybody. We've actually got somebody who is dedicated just to my channel. So if anybody happens to be listening, tell them that you heard about us from Jeremy, and so they can call. It's an 800 number we've got set up, Jeremy, just for you. It's 866-703-6883. Again, that's 866-703-6883, and that's not going to just put you into some generic loop, and that's going to put you directly in touch with one of our senior loan advisors. His name is Ed Kiss, and he is dedicated just with working. He works just with some of our partners and friends. And so anybody that comes in, they'll be able to connect with him. They can also connect with him directly in the event that they wanted to email through eKiss. That's EKIS at lending1.com. So
That's great.
eKiss at lending1.com, or call 866-703-6883. And they'll have a direct line into Jeremy, or I'm sorry, into Ed, and tell them that Jeremy sent you, and we can take great care of them.
Well, that's great. We have our own 866 number. That's
There
awesome.
you go.
Well, Josh, again,
Absolutely.
I appreciate you coming on. I've learned a lot, and it's exciting what's going on out there. And I really appreciate you coming on and sharing what you're all about.
Hey, well, thanks so much for having me. I really enjoyed it.
Yeah.